An exchange-traded note, or ETN, is a contractual obligation by an issuer to pay the holder a return, which in this case is linked to the performance of the underlying metal price. Tonight we'll be reviewing the new wave silver and platinum ETNs. And as I said, we've got our guest host with us, Kobie Rachanje, Roland Rousseau, and our special guest host for this evening, Vladimir Nedeljkovic. Vladimir, let's start off with you. Let's get a quick review on what the difference is, firstly, between an exchange-traded note and an exchange-traded fund. Yeah.
Thanks. I think from the investor's point of view, those two products look pretty much the same. There are a couple of important differences that one needs to take into account. First of all, exchange-traded funds are structured as insolvency remote vehicles, basically in generally collective investment schemes or unit trusts. In essence, with the ETFs, you have a portfolio of assets sitting in some kind of a trust, issuing securities that are listed. So the investor has full recourse to that underlying asset. With ETNs, on the contrary, the issuer of an ETN is a bank normally, and the investor in an ETN has a credit risk to the bank. So that is an additional risk that the investor takes. Apart from that, they're pretty much quite similar. The ETFs are generally perpetual, as any other fund, while the ETNs are generally longer term, so quasi-perpetual, between 10 and 30 years.
And just explain to us what that means.
Well, it means that if you, as with the unit trust, when you invest in a unit trust, there's never an end date, never maturity date. You invest in a fund and it goes forever. And ETFs are similar to that. With an ETN, it is a note and it has its duration. So at the end of the period, and those periods are between 10 and 30 years, when the note expires, you will receive the proceeds back. Of course, you can always trade those notes in the secondary market as you would do with any other share or with an ETF. Liquidity-wise, again, they're pretty much similar. You would have the same market maker providing liquidity both on ETFs and ETNs. They would normally tend to track an index or an asset portfolio of assets, commodity in our case. And in both, the investors have an opportunity, some investors that want it, and if they have a block of securities, they can subscribe in the primary market. So with an ETF, you can come to an issuer and says, here's my million securities, I want the underlying. With ETNs, obviously you don't get the underlying, but you can get the equivalent cash.
Okay, so that's pretty much ETNs in a nutshell. Kobie, what are your views in investing in commodity-based ETNs?
Well, look, I mean, let me first start off by saying, Samantha, that I think it's fantastic that there's a whole range of new kind of asset classes coming to the market and a whole new set of instruments that you could potentially now utilize in portfolio construction. You know, previously, if you wanted to get platinum exposure, you needed to get platinum exposure through actually buying the miner. You couldn't get it by just actually buying the actual...
And then you buy all the other problems that come along with that.
No, absolutely. Now, I mean, the two are actually related to each other. If you look at your screen at the moment, you'll see the price of Anglo-American Platinum and Impala Platinum, and you could see those relative to the platinum spot price. And platinum spot price there is actually indicative in the orange line that you're seeing moving over there on the screen. And the other two are the two company lies. There's Anglo-American Platinum and there's Impala Platinum. Now you can see the two actually, there's a big correlation between the two. But now suddenly you can take away the company fundamentals and you can get metal exposure. So the fact that you can get metal exposure now I think is fantastic, and it means a huge amount for portfolio construction, I think.
Roland, let's bring you into the conversation. We're looking at a platinum and a silver ETN. When you're looking at constructing a portfolio, would you want to get exposure to those two commodities?
Generally, when you're constructing a portfolio, the key quantitative aspects that one has to keep in mind are things like volatilities and correlations, because if you're trying to build a diversified portfolio, you've got to look at those things rather than the returns necessarily of the shares or the asset classes. Now, where commodities are very useful is, and most people don't know this or appreciate this, but the oil price or the gold price or the platinum price or the silver price is actually not very volatile. So from a volatility perspective, commodities, we think the gold price is incredibly volatile, but it's actually got 1/5 of the volatility of a gold stock or a gold company. So you're not getting higher risk by buying physical assets. So that's a key thing. The second one is that the correlations of these commodities often move in opposite directions when our equity market has a crisis. In other words, when everything's collapsing, these kind of assets actually go up in value because they are seen as alternatives to equities in terms of safe havens. Gold is seen as a long-term traditional way to avoid equity risk. So you're getting very valuable counter-cyclical elements in terms of correlations and lower volatility from these kind of asset classes.
Vladimir, why did you choose to go for platinum and silver then?
Correct. Well, as Roland mentioned, I think especially investment in commodities, it is becoming quite popular because of the correlation, the low correlation between commodities as a asset class and other forms of investment, other asset classes. Now, there are commodities and there are commodities. I think we've started with gold because the gold has a very special status and it basically has a role as almost as a reserve currency. But other precious metals such as platinum, such as silver, they also have their role. Again, low correlation. Two, they're very liquid. You will talk about how our ETNs are constructed. We are actually not tracking the futures price of these commodities. We are actually tracking the spot price. So we are hedging with the physical. Now you will appreciate that it's very difficult to hedge in physical with most commodities, but these two, the precious metals, are special because there is a very active and very deep spot market for those, and we can actually create quite an efficient product using those.
Is it true to say that silver and platinum have a lot of industrial applications, whereas gold is much more, it's got a lot of industrial applications as well, but it is very sentiment based and it is linked to like a currency kind of element embedded in the performance of the gold price. But people need silver and they need platinum. So when we have industrial growth or GDP growth, you're actually getting an underpin in these kind of commodities which you don't necessarily get in other ones. Absolutely
correct, and that is one of the main differences that people have when trying to analyze the gold price versus the price of other commodities. Because when you analyze the gold price, you have to look into the sentiment and the market fundamentals and all the other issues. When you analyze the platinum price or the palladium or the silver price, it is related to driven by demand, the industrial demand, whether we are going to use platinum in a particular type of catalytic converter and so on. So then you have a proper fundamental analysis of the supply and demand factors.
You see, I think that's the important thing here. You can fundamentally link them, you can understand them, and then you can have a look at company fundamentals, and you can kind of make a decision from a portfolio construction perspective. What is it that exactly that you want to do? I think Vladimir made the point just now. There's a difference between the spot price and the futures price. Now, what you're getting here with this exchange traded note is you're getting spot price exposure. Have a look at your screen, and you'll see the difference between the spot price and we're looking now specifically at platinum, the spot price, and the actual index, which is the futures price. Now, you can see the two track each other very, very closely over time, but there is slight differences that actually appear through time. Maybe there's a question here for Vladimir. And we're seeing exactly the same thing with the silver spot relative to the futures price as well. Is there a difference here in how you actually price this? It's what we call roll yield.
Yeah, that is correct. And those differences, when you see it on the screen, it looks tiny. But it is for platinum, it is around 50 basis points, so 0.5% a year. And for silver, it's 1.5% per year. So that is a significant difference. And
so how does that feed? Sorry, just to interrupt. How does that feed into the return that you're going to get as an investor?
Well, that is the main point, because if you're investing in a product tracking the spot price, you will get the spot price. if you invest in a product that will track the futures price of a commodity, you will get the returns on a futures price or the futures index. And of course, there is that difference. So there is a drag in the performance. In this particular case, it is because of the something called the rolled yield. And in the case of precious metals, because the precious metals are in something called the contango, i.e. the futures price is more expensive than the spot price. The futures indices are constructed by assuming that you will investing in futures indices, futures prices of those commodities, you will roll those futures contract. And by doing that, you are underperforming the spot price. Now, it is something that is known, and you can think of that differential, it's something called convenience yield, and it really has to do with the storage cost. So if you just to make it quite simple, if you invest in an ETN of any sort, you will have to pay a management fee. Now, by investing in a futures-based ETN, you're paying a management fee, and you're kind of paying another fee, which is your roll yield risk, and that is a risk that lots of people do not understand. And for more, when you invest in a commodity, you want to track a spot price of a commodity.
So when contracts expire and you roll it into the next contract, there's a difference between the previous contract and the next contract's price, right, and you have to take that profit or loss, which creates that drag. Exactly.
So overall, when we're looking at the returns that you'll get from investing in these new ETNs, and of course we're focusing now on the commodity ETNs, what is the overall return that you're looking at going to be based on?
Well, it is purely based on a spot price of the commodity. So the calculation of the return is very simple. You take the dollar price of a precious metal. You will multiply it by the rand-dollar exchange rate, because obviously our ETNs are traded in rand, and you divide it by 100 because each of those ETNs is 1/100 of an ounce, and that is your price. Simple as that.
You see, I think from an overall portfolio construction perspective, the one thing that you want to get right here is you want to make sure that you get the general direction of the metal right here. So let's assume you're sitting in a crash and you can buy the metal at a very low level. Well, you might decide to potentially buy the miner, but the miner potentially might have lagged earnings, which means there's now price pressure and price risk that you take on as far as that's concerned. But when you're buying the metal off a low base, what's the next movement for the metal? Well, it has to be kind of up. So the question is then, how do you participate with that, and how do you then build the total portfolio as far as that's concerned? And I think that's kind of important here.
Okay, then that brings up another question. What about the downside risk with a product like this?
Well, there are two downside risks. Well, two main risks with ETNs. The first is the market risk, obviously. So you need to, on the market risks for precious metals ETNs, you have to have a view on the price of platinum worldwide in dollar price, in dollar terms. Two, you have to have a view on the currency movements, i.e. what the rand-dollar exchange rate is going to do, because obviously you have to combine these two in order to get an overall return. And three, as I mentioned, there is an element, by investing in an ETN as opposed to an ETF, you are taking an element of a credit risk on an issuer, i.e. what is your view on Absa Bank or Standard Bank or whoever the issuer of a particular ETN is. Are they going to default or not? Obviously, in the South African market, the most investors are not, our banks are quite strong and investors are not terribly concerned about that, but it is an element of a risk.
Well, how would you evaluate these risks if you were constructing a portfolio?
Well, again, as I mentioned earlier on, just to give you some numbers, the average volatility of the gold price in dollars is between 10 and 20% per annum. The average volatility of Harmony Gold is 40 to 50% per annum. So we've been grown up or been trained to believe that if you're holding shares, you are sort of holding something that you can touch and feel in terms of it's a company and it's generating earnings. But these things are volatile. They are much more volatile than the metals. So I think metals provide a very valuable diversification element in a portfolio.
Look, I want to say something. I mean, you know, I think from a JSE perspective, I think this is fantastic as well. We're a metal-based country. So you want to make sure that the international community can come here and actually buy metals on your actual exchange. And you're basically providing that. And I think that's a fantastic conduit in order to actually get more people interested in actually engaging with emerging markets such as South Africa and show them the quality of, you know, of the exchange and how liquid it can really be, you know. So, and I think that's a fantastic way, you know, and hopefully, Vladimir, we'll see many more of these kind of metal kind of ETNs coming to the market, which will be fantastic.